we are going to do a practical question. I've worked out 3 questions. We'll see how far we get. If we do not finish, what I'll do is I'll upload the questions is on VC Learn. I'll upload the suggested solutions so that you guys can go through it as well. I did not do the most complicated because of the fact that we have limited time, but this is just a different way of how they could structure a question or ask it as well. Okay, so the guys online, I'm going to start with the PDF and then I'll tell you when we move over to the Excel file. Can you just let me know if you can see the Excel when we go on with that? Okay, so the first question, if we scroll down to the required, they ask you to work out the tax liability for Buttercup Pty Limited for the year ended 31st of March. Okay, now remember when we talk about tax liability, it is our taxable income multiplied with our tax rate, and then we deduct any prepaid taxes to work out the physical liability. So what you would expect to see in the question is some provisional tax payment. So based on that, just above that, you can see there were provisional tax payments. Sorry, this should be 2021. So just above it, you can see there were 2 payments during the year, which we will have to take into account. Now, because of the fact that we have to work out the tax liability, that would mean we have to do the tax framework. So start off with your gross income, less any exemptions, less any allowable deductions, which is made up of your general deductions and your capital allowances, and then add any taxable capital gain. And then if there was a donation, deduct the donation just before we work out the taxable income. So let's go see what information have they provided to you. So they tell you we are a small business corporation. Now, as soon as you see small business corporation, section 12E needs to pop up, which is your capital allowances. And then remember there is a SBC tax table, which is specifically applicable for a small business corporation. Now that tax table will be provided to you in the exam as an annexure. Then we told you for tax purposes, our year end is 31st of March. So we know our tax period is from 1 April 2020 up to 31st of March 2021. Now the next thing, and this is where you need to go look carefully what they tell you in the question. So in this question, I have specifically gone and told you amounts are exclusive of VAT unless indicated otherwise. Now because I've specifically noted this, there are some components where VAT might need to be accounted for when you do the income tax calculation. If you do not see something like this, you do not see in any of the amounts that they tell it's inclusive of VAT, then you ignore that when you do the taxable income calculation. But because we've specifically indicated there are components of that, you will deal with it. Okay, so let's see what information do they give you. So they've given you the sales value, and then there's a note. Then they've given you profit on sale of an asset, note number 2. Then there's interest income, cost of sales, salaries and wages, rental expense, computer expense, accounting fees, advertising in a local newspaper, insurance on the life of a director, pension fund contributions of employees, and depreciation. Now, based on this table, your profit on sale of an asset is an accounting entry. For tax purposes, you have to go look at whether it's a recoupment, and you have to go work out the capital gain. This amount that I've given to you here, you do absolutely nothing with it. You have to go work out what the tax amounts are. Similar to the depreciation. So the depreciation is not actually incurred. For tax, we look at your wear and tear or capital allowances in that instance. So we do not look at the depreciation amount, we look at whether there's a wear and tear or capital allowance that I need to take into consideration. So this is where I've basically almost given you a trial balance or an income statement for that matter, which have entries which we ignore because they don't comply with the tax specific rules. Okay, so let's look at the additional information. Okay, just one more thing. So in this, we can see advertising in the local newspaper. This is generally a once-off. Advertising in a local newspaper is not seen as a capital expense because it will not create an enduring benefit. It's generally for a very short time. It's generally for specific sales that companies have at a specific point in time. So this one would actually be revenue in nature because it does not create an enduring benefit. Okay, so this one you would be able to deduct. Okay, now let's go through the additional information and see what is. Okay, so we tell you sales amount is inclusive of VAT. Okay, so that amount's inclusive of VAT, and it is made up of local sales of 800,000 and export sales of 400,000. So I've already told you that amount's inclusive of VAT, and then I've given you two types of supplies. The one is a taxable supply or standard rated supply, which is 15%. And then I've given you the export ones, which is zero rated supplies, which is 0%. So what you have to do for this specifically in the question is you would have to go show them separately because the VAT component will look different. And then you need to remove the VAT for your taxable income calculation because that would have been dealt with separately. Then the next thing is we sold the shop that it owned on 1 August 2020. So that would mean we work out wear and tear or the capital allowance up to the date just before that. We tell you the profit of an amount of, oh, I didn't even update this. Okay, so this profit amount should actually be the 230, sorry. Okay, so this profit is 230. Okay, the premises was purchased for 450,000. Oh no, this is not. Okay, this is not the profit amount. This is actually the sales amount. Okay, so the profit should be 230 here, and the sales value was 650. Okay, so I'll just amend that and upload it for you guys again. Okay, then they incurred some additional expenses. So you can see they've incurred agents' commission, legal fees, repairs, and maintenance. Now, these additional fees, the agent's commission and the legal fees, these you add to the base cost when we do your capital gains tax calculation. However, repairs and maintenance we show as a deduction, so that does not get accounted for when we do the capital gain. Then question 3 is the company purchased raw materials amounting to 661,570, including VAT. So because it's inclusive of VAT, we need to exclude the VAT, and they paid transport value of 8,600. Now, because I do not mention anything regarding VAT for the transport, it is assumed it is exclusive of VAT as mentioned in the beginning. Then I tell you the opening stock is 23,800. The closing stock is 54 600. So we also need to adjust our entry for the opening and closing stock we have on hand. Then we've got a list of debtors, and I tell you the debtors is 10,000 Rand. I tell you the aging. So I give you the age analysis. So 3,000 is between 30 and 60 days. 2,000 is between 61 and 120 days. And 5,000 is over 120 days. Bad debts written off was 20,000. And I tell you the prior year's allowance for your doubtful debts was 4,000. And we do not apply IFRS 9. So because we do not apply IFRS 9, we account for the 25 and 40% based on the age analysis. Okay, then if we go to point 5, the company purchased furnitures and fittings for 90,000, including VAT, on 1 June 2020. Okay, and then we've got the provisional tax payments. So now let's go look at how to do the calculation. So guys, I'm just going to stop sharing this, and then I'm going to share the Excel file. If you guys can just let me know if you can see the Excel. Okay, the guys online, can you see the Excel file? Okay, so we said we start off with the sales value. So the first thing we have to show is the sales, but we have to go and split it between local and the export sales. So as you can see from here, the local sales was the 800,000, and we removed the VAT component because it was inclusive of VAT and it is standard rated. So we multiplied with 100 over 115 to get to a value of 695,652, which we will include in our taxable income. The export sales, however, is zero rated, so we include the value inclusive of VAT because it has a 0 Rand VAT component, so it would actually be 400,000. So what I've done here now is I've tested whether you know what's supposed to be included in gross income. I've also tested the VAT, whether you know how to deal with standard rated and 0 rated VAT altogether. Okay, then part 2, if we look at the tax table, we had the profit on the sale of the asset and we had interest income. Okay, so the interest income, let's deal with that first. So the interest income was 8,000. Now for a company in a CC, we do not get an interest exemption. So you don't have to show the following line item. This is just as additional information, just so that when you recap this, you remember this. For an individual, we do get a partial exemption, but because we're dealing with a company, that exemption was not applicable. Okay, then with the sale of the shop, we first have to work out what is the recoupment amount, and then we only do the capital gain. Now remember, for the recoupment, we need to work out the tax value, the carrying amount. So we start with the cost price, then we work out any allowances that we have received. Okay, so we start with the cost, and in the question we said the cost price is 450. Now the allowance we receive, because we have a small business corporation, it is 50, 30, 20% basically for any non-manufacturing assets that we apply. Let me just see if there's any questions. No. So what you then do is you go show all the cumulative wear and tear in the question. Now, because we purchased it in 2020, we purchased it, let me just see what was the date. Okay, so it was on 1 April 2019, so it would have been from 1 April to 31st of March, would have been a year. 2020, it's 50%, year one. Wow. Okay, guys, can you still hear me? Because I'm hearing myself here. Okay. Okay, so in 2020, it was 50%. In 2021, it would have been 30%. Now remember that this 135,000, because I've showed that calculation for the recruitment and the gross income, that 135,000 needs to be shown under your deductions. Sorry, that's repair maintenance. Where did I put it now? Okay, so you need to show the capital deduction for that item also under your deductions. Okay, so I've already done the calculation here at the top, but then I need to show it as a deduction if we use the framework. So then we work out the carrying amount of an asset at that stage is 90,000. Now for the recoupment, you start with the recoupment is 650, which is what we sold it for, but then we limit it to the original cost of 450. And then we deduct the 90,000, which was the carrying amount from that 450 to get to a recoupment value of 360. Okay, so that is working out the recoupment. Now, while you're still busy with the recoupment, you can then also go do the capital gains calculation at the same time. So the first step is we've got the proceeds, which was the 650, and then we deduct. Let me just make sure I deducted the correct amount. Okay, the recoupment was 360. So you deduct the 360 from the 650, and then you get 290. Then for the base cost, we take the 450, which was the original cost. We deduct the recoupment from that. So currently our purchase price, what is left over is the 90,000. So that is basically the carrying amount at that stage. Then we deduct the agent's commission and the legal fees that we incurred in selling that property to the base cost. And that gives us a gain of 162,500. But now remember, we don't include the full gain. We only include 80% of it. So the inclusion rate is 80%, and then our taxable gain is that 162,500 multiplied with the 80%, which gives us a taxable capital gain of 130. Now, if you've got multiple assets, you will have to do this calculation for all of the asset, the gains, add it together, and then only your net gain at the end of the year multiply with 80%, but I've only had one asset I sold. Okay, then the repairs and maintenance, we said you have to show as a deduction separately because it is not form part of the base cost. Okay, then we said for the cost of sales, our information said we purchased raw materials of 661,570, which was inclusive of VAT. There was transport cost of 8,600, and then we had the opening and the closing. So you show the raw materials, but then you exclude VAT from that amount by multiplying it with 100 over 115. And then your transport is already exclusive of VAT, so we just take the 8,600. Then we deduct the opening cost, which was given to us as 23,800. But the closing cost we add to our gross income line item there at the top, and we add it back as 54,600. Okay. Then if we add all of that together, our income You can do it separately, but I've just done the income less the exemptions because there weren't any exemptions. So the income at that stage is 1.5 million, 22,252 Rand based on what we've got. Now let's see what other expenses we have. So if we look at the table, we've got salaries and wages of 250,000, rental expenses of 72,000, computer expenses of 5,000, accounting fees of 12, and then advertising of 3. So let's bring that into account. So those items you literally just write down from the table and just go enter it into the calculation. Then we had the insurance of life of the directors of 10, the pension fund contributions of employees of 5.5, and then depreciation we said is not included because it's not actually incurred. So I just indicated it as a 0 to show you it's not supposed to be shown in here. Then if we go on to the rest of the information. So then we've got our provision for doubtful debts. So we said in the prior year we had 4,000. So normally we add the 4,000 here at the top. We add it back under your gross income, the 4,000 amount that was given. And then in the current year, they've given you the age analysis. Now we give you the age analysis so that you are able to go do the calculation of the 40%. So everything over 120, which was the 5,000, multiply with 40%, and then everything between 60 and 120, which was the 2,000, is multiplied with 25% in your calculation, and you deduct it in the current year. Then we purchase furnitures and fittings to the value of 90,000 on the 1st of June. Now, because we're still busy with a small business corporation, that furnitures and fittings, and then we had the bad debt, which was 20,000 also in that paragraph. That furniture and fittings, because of the fact that we have a small business corporation, we apply. Okay, wait. I don't know where the computer just popped out. Okay, let me just highlight that. I think I should have deleted that. Okay, so the furniture and fittings, we take the 90,000, we exclude the VAT from it, and then we apply the 50%. You just see, I don't see anything about a computer, so this line item should be deleted. Okay, so then based on all of that information, we then go add up everything. Just make sure I've got the correct. So I add all the income, deduct all the expenses to get to the taxable income amount of 466,693. Now they ask you for the tax liability. So now what you have to do is you apply the SPC tax tables. Okay, let's quickly see what the tax tables are. Okay, I'm just quickly going to open the tax tables here. Okay, so if we look at the tax table, so we are busy with the 2021 year end. So that means this is the tax table that we have to apply. So I'm just going to copy and paste it into the Excel file. Okay, so based on this, and this is the tax table they would have given to you. Our taxable income is 466,000. So that means we are actually sitting in this line item there. So the 365, 500 to 550 bracket. So that means 19,733 Rand plus 21% of everything above 350 will be taxed. So based on that, our calculation would look as follows. So we've got the 19,733, 21,000 multiplied. So then we take the 466,693 and we deduct the 365. Now in an exam, you need to show me this calculation. You generally get half a mark for that amount, half a mark for the 21%, half a mark for your amount, that's generally a method mark, and then half a mark for the 365. Okay, so it's 2 marks that you receive for just doing the calculation. Okay, so let's quickly just fix it here. Okay, so then the tax based on the SPC tax tables would have been 41 and 98 Rand. Okay, now for companies, you do not get rebates. If you are an individual, you would get a primary, secondary, or tertiary rebate depending on your age. So the normal tax payable currently is 41,098 Rand. Then our prepaid taxes is 45,000, which was the 20,000 and the 25,000. So what happens now is we actually have a net tax refundable of 3,911 based on the new tax tables. Okay, so that is how you had to do question 1. Do you guys have any questions on this?
Where do you get the
Okay, what?
the prepaid taxes?
Okay, so the prepaid taxes amount was here right at the bottom, the provisional tax payments at point number 6 is where I got that information. The guys online, do you have any questions on question 1?